Welcome, everybody, to another episode of the Tech Guys Who Invest podcast, where we teach you how to invest wisely and safely. This episode, we have Lane Kawaoka from Simple Passive Cashflow, and we are here to talk to him and learn all about Simple Passive Cashflow. So welcome, Lane.
Yeah, thanks for having me, guys. Appreciate having me.
Yeah, we're excited to have you on, Lane. So I'm going to jump right in and ask the first question, which is, where do you stand with investing for appreciation versus investing for cash flow?
Oh, you guys are firing me up already. I don't invest for appreciation. Back in 2009 to 2012, I invested in Seattle, another primary market, and I don't like investing for appreciation. After I had those 3 units in Seattle, I went all out of state to markets that make sense. I live in Hawaii. I don't invest here. Nothing makes sense. Nothing makes sense in California, Washington, Seattle. I invest where the numbers make sense, where the rent to value ratios are 1% or higher. So.
Interesting. Yeah, that's great. Now, Lane, a lot of people who are just finding out about real estate investing and just starting to learn about investing for cash flow don't really understand that there are a group of people out there like you, me, and Kevin who invest for cash flow. Could you talk a little bit about that?
Yeah, I mean, most people invest for appreciation, right? I mean, it makes
Right.
logical sense.
Mm-hmm.
Buy low, sell high. But I think investing for cash flow is just more prudent. And the end game that anybody should have is not the build up a whole bunch of money and accumulate. The accumulation theory is what we call it, right? Where you put a lot of money into your stock portfolio, your retirement 401k, it grows to 2 to 5 million, then you can withdraw on it, slowly as you wither and die in your old age, right? That's the traditional model, but the prudent way of doing it is, which is what nobody really does, is like you build up streams of income, right? Multiple streams of income. So each round of property is a stream of income, a little mini pension or syndication or whatever a half may be, right? An asset that's producing income. And then you go ahead and accumulate a lot of them, right? So when a pandemic happens, right, you don't just have your job or this business, that business, but you have multiple houses out there. I'll bring you income.
I love it. And then you were talking about cash flow, and it's funny because you can invest for cash flow and still have the property appreciate. But if you just go for appreciation, you're banking on one thing. So all your eggs are in that basket, and there's no guarantee the appreciation is going to do anything for you. So I love that approach.
Yeah, I think the problem that I have with people investing in primary markets, I'm fine with you investing for appreciation. I mean, I personally kind of do it today. I'm doing some development type of stuff today, but because I got my bases covered, I got my daily living expenses covered 2x at this point. I don't really need cash flow, right? And I think that's when I was first starting to do this 10 years ago, I wanted to quit my day job as an engineer and I wanted cash flow. So that was the number one objective. So I was focusing on things that were in cash flow type of areas. And then I gave up the appreciation. I didn't, of course, everybody wants it, but you can't have both, right? You can't ride 2 horses, as I don't know who Buddha said that or something like that. You can't have both. Like a lot of my guys, they're like, oh, I want a good appreciation market and I want some cash flow. It's like, dude, that's not going to happen, right? This ain't 2010 anymore. It's just not here, right?
Yeah, it's a very good point. So taking a step back, how do you define simple passive cash flow?
I mean, like real estate investing is kind of a huge term, right? I mean, you get a bunch of stuff, especially you go to like, the big websites out there and it's just like all in your face, right? Like wholesaling, flipping, tax liens, all this stuff. I kind of distinguish everything, either it's active or passive, right? Like most of my guys were high paid professionals, doctors, lawyers, engineers. Already, it's like, look, man, cool. You have some money to invest and you're able to, that's your highest and best use. So the path is passive investing. At that point, all this other crap goes away, right? I just got off a mastermind with Derek Simmers. He's a big minimalist, right? He got rid of his like middle name or something because he didn't need it, right? Like I try and keep things really simple because I cater towards high paid working professionals who are busy, right? If you're broke, you don't have any money, you probably have a money problem. I'm not the guy to help you, right? There's a whole bunch of like Susie Ormans, Dave Ramsey's out there. And then there's all these real estate active activities like BRRRRs and all that type of stuff. I don't do any of that, right? I buy and hold, and I focus on building relationships with other investors, finding good deals, and more accredited investor type of activities, which I think that was where, like, when I, had 11 units back in 2015, and my investing really took a hockey stick. Like, I started to find what other accredited investors were doing, were much older than me. And I realized, like, the secrets of the wealthy at that point. People were doing things very differently than I was doing in my first half of my investing career. And come to find out, they're very simple, right? It's just very, you don't hear about this stuff. My parents didn't teach me about it.
Yeah, so Lane, we love to share those kinds of things with our listeners because we're trying to help educate people about how to have that wealthy mindset and how to move in that direction, especially if they're just getting started or still pretty early on their investing journey. Could you talk about a couple of things that stand out to you that you learned that the wealthy do, or how the wealthy think that others don't?
Yeah, so I'm gonna kind of predicate this. This is, mostly accredited investors talking about this stuff, and it's very
Mhm.
alternative to what mainstream financial advice is. But, like, number one, they don't invest in retirement accounts, right? Like, I want my money out of these accounts where the government has a tax lien. Yeah, even Roth IRAs, right? Like, I want to invest in deals that do cost segregations so I can extract a huge sum of bonus depreciation year one to stockpile as passive activity losses, right? Because I'm also playing the game at real estate professional status to be able to kind of flex my adjusted gross income to choose how much taxes I would like to pay that year. That's kind of kind of a box on its own to unpack. Got a lot of stuff on my website on that stuff, but for free, all for free. But that's like the kind of the stuff that more of accredited investors kind of talk about, right? Like, deal flow is probably only a third of it, but like tax planning and legal structures and how do you create your legacy is kind of most of it. It's definitely first world problems.
It's a great way of phrasing it, but you're absolutely right. Um, when you talk about, like, on your website, you talk about the Atlanta or Alabama, Georgia, Indiana, those types of markets. How did you decide that, hey, let's focus on these markets versus, I don't know, on the East Coast or something?
I mean, like, you hear about all these markets, right? I mean, Birmingham, Atlanta, Indianapolis, Kansas City, Memphis, Little Rock. These are all the places that you hit your 1% rent to value ratio and you're not in a D class, C class, C minus class area, right? You're not in a war zone area. Up to that point, I'd say, like, I notice people spend too much time. A lot of my guys are engineers and they make all these spreadsheets and power rankings with all this data. I don't know where they get this data from, but then I'm like, dude, like, you got to spend time talking to the people, right? Because you're not looking for a property in a certain MSA market, like Atlanta, for example, right? Like, Atlanta has few dozen submarkets in Atlanta, right? And even in those submarkets, there's sort of an infinite amount of neighborhood blocks, right? The only way you're gonna figure out if you're buying the limit on the block is by building a relationship with the right property manager or a broker.
Okay.
Yeah,
And
yeah, it's good.
just to level set for listeners who haven't heard of the 1% rule, can you describe it when somebody asks you, hey, I don't get what that means?
Yeah, so 1% rent to value ratio is what you need to be able to cash flow. Of course, you have to go and underwrite the deal yourself. And people can get my analyzer on my website, simplepassivecashflow.com/analyzer. It's free. You have all, like, you can break down expenses, CapEx, all that stuff, blah, blah, blah. But quick and dirty way, because we're kind of skimming the surface on podcasts. That's all podcasts are, right? Just skimming the top, right?
Right.
Just the tips,
Yeah.
right? You go take the monthly rents divided by the purchase price, and that is your rent to value ratio. So a lot of the places that we're targeting are like, 1% or better, where rents are, let's say, I'm just going to throw out some simple numbers, $1,000 a month and $100,000 purchase price. If you were like me and a lot of my folks, the first year, you're like, your head exploded, right? Like, yes, most people live in houses that are 80 grand to 120 grand, right? We are the weird ones that live in Hawaii, San Francisco, Seattle, right? You shouldn't come. Like I live in a like kind of a junky beat up house here in Hawaii, but it's $1 million. If it was in Des Moines, Iowa, it'd probably be like $200,000, right? We're the weird ones, but most people in America, right, and where you want to invest, we're in the bell curve of the population where we need good value homes, are 80 to 100 grand, where the rents are anywhere from like $800 to $1,000 a year. So you need to be above that 1%. So if you're at home right now, you go in Zillow and you look at your neighborhood or where you're looking at, just take something like 80% of median home price, right? It's like, I think Birmingham's like 150,000 median home price. So you go 80% of that. You look in that range, you see how much it rents for. I think Zillow even has a, like this is its estimate or whatever. If you want to spend a little bit more time on it, go run your own comps in Facebook Marketplace, Craigslist, Rent-A-Meter, Hot Pads are great ways to find that. And you go monthly rent price divided by purchase price. If you're under 1%, don't bueno, man.
All right, good advice. So I'm going to take a step back, Wayne. I know you went from being an engineer, a full-time employee, into what you're doing today. And I'm sure a lot of people listening to this are thinking, wow, it sounds really fantastic where he is now. How did he get there? Can you talk a little bit about your transition from full-time employee as an engineer to professional real estate investor?
Yeah, so currently today I got over 4,000 units under ownership, but like what people don't realize is like the first property I bought was in 2009, and then the second was a duplex that I bought in 2012, right? Like I was constrained by how much money I was able to save. And at the time when I first got out of college, I was making like 80 grand a year. It's funny how like wages haven't really gone up too much, but
Yep.
No kidding.
yeah, that was back in 2009. And I was able to save, like, here's like my big like thing that separated me from a lot of people. Like I was super cheap and frugal, and I lived on the road on company expenses. So I was able to throw like 50 grand into savings or into investing every year.
Wow.
Wow.
So that's what allowed me to buy those first few rentals pretty quickly, but still took like a couple of years to buy the next one, right? And then, as you can imagine, it was kind of like watching grass grow. Eventually, I got up to 11 properties in 2015, right? But people don't realize like this is not a get rich quick thing, but it's a get rich surely thing.
Love that. I love
Yeah.
that soundbite. That's a very good way of putting it.
And it's like, bro, you need some money, right? Like this is real estate investing. If you don't have money, you can't invest. I'm not the person that kind of help out, right? Like if you can't save, most of my investors are able to save maybe like 30 grand a year after all expenses and their day job. The better ones are obviously above 50 plus, like the more accredited guys. But if you're saving less than 10 grand a year, that might be that's the starting point, right? Like you save 10 grand a year, in 2-3 years you can buy that first rental, and now you're saving a little bit more money every year, right? And that's just how it goes, right? This is the journey to simple passive cash flow. This isn't a get rich quick scheme.
Yeah,
I like that. And you do have to remind people of that, because that's part of investing wisely and safely. So if you invest with the means to get rich quick, you're probably be most likely going to be gambling your money. So that's a great great way to put that out there.
Yeah.
So when it comes to, you mentioned also that there are certain drawbacks with self-directed IRAs and EQRPs. We'd love to hear what you mean by that, what those drawbacks would be.
Yeah. So like when you are investing in like some kind of retirement account, QRP, self-directed IRA, like you're investing in that program, but kind of separate two things, right? Like when you're investing in a 401k, none of the wealthy like to do that, right? Because you're investing in a bunch of garbage Wall Street retail investments, right? And when you follow the herd, you get slaughtered with the herd, right? I mean, that's what upsets me so much, and why I'm so passionate about this stuff, and why I like blog and podcast on this stuff all day. It's like there's so many hardworking Americans out there. Like we were all fed this lie, right? To go to school, study hard. Like happened to be good at math and science when I was like 9 and 10, so I got turned into an engineer. Like I'm a product of the system, right? I got a master's degree. I hang it upside down in my office today. It means nothing to me. right? Like, granted, it did get me a good day job in the beginning. That's how I saved money, right, to buy these investments. But like, we're all fed this lie, and it's engineered system to like keep us working for 40 years. But I digress. So like the 401ks, all that stuff, the wealthy don't do that stuff. They invest, they self-directed, right? So now we're into like the QRPs, the self-directed IRAs, the solo 401ks, right? I don't really like those personally. Several reasons. Number one, I don't want to wait till I'm 65 to retire or get at that cash, right? Like people who do this passive investing that are able to save at least 30 grand a year, yeah, you're going to be retired in 5 to 10 years, most likely. So if you're 45 right now, you're probably retired by 50. So if you invested it through one of these vehicles, you got to wait another 10, 50 years to get out that cash. Number two, I would rather pay my taxes today while my tax bracket is lower, right? Most traditional financial wisdom, which is wrong, is assuming that when you get older, you're going to scale back all your expenses, shrivel up and die, right?
Literally and financially.
Yeah, I'm a pretty optimistic kind of guy, right? I think I'm going to make more money in the future, right? Like, I don't know. So therefore, my tax bracket will be likely higher in the future. So I want to pay my taxes today while I'm in that lower tax bracket, right? You're going to pay taxes one way or another, either
right
now or later. Third, like look at the way this country's going, right? Just create all this stimulus money that's just pumping up the stocks with all fake money. How else are we going to pay for it but inflation, right? Or taxes. So it's going to be both. I mean, that's why I say buy real estate, so you can ride that wave of inflation when it happens, because inflation is nice because the politicians don't get in trouble. They just blame it on inflation. It's like, oh, it's crap. Right? That's not our fault, right? But they're going to have inflation, but you're also going to have your general rise in taxes. It's a no-brainer. So I'd rather pay the taxes today than what it is in the future. It's always a little bit of a gamble, which way or another. But the way I see it's going to be, for those 2 reasons, actually 3 reasons, I want to take the money out and self-direct it and get it out. But here's the kicker, right? Like for accredited investors that invest mostly in like syndications and private placements where you're going after very large asset, you're doing a cost segregation. And now the way bonus depreciation laws are, you're getting a huge amount, like most of your depreciation out in year 1. So those investors out there are probably familiar with like depreciation on single family homes, where you're able to take 1/27 of the depreciation every year for 27 years, which is super boring and lame, right? Like with the cost segregation, you're able to take almost like a third of the whole property value all in the first year. Boom. You can't get any of that and pocket it as passive losses to use at your choosing until or if you're investing in one of these retirement accounts. So again, that's another reason why I want my money out of that stuff.
Money now. I like
That's
it.
good. Yeah, me too. It's really great to hear your thought process as a more sophisticated investor with experience and some wisdom under your belt there, and to share how you're thinking about that, because a lot of people don't they haven't heard that point of view. So thanks for sharing that. Really appreciate it.
I just focus on like the main things that actually matter, right? Like all this tax liens and all this garbage, and it's all noise to me. Like that's not what like higher net worth, high paid professionals do. We don't worry about that, but we key in on these very important things, the 80-20, if you will.
Yeah.
20 rule.
Yeah,
That's a very good point.
Absolutely. So Wayne, what skills do you think you used as an engineer are helping you as an investor? Like, have you ever thought about that? Like you mentioned you were strong in math and science. Maybe there's something in there, or maybe it's something else. We like to help people think about, if I'm in a W-2 job right now, what can I maybe do to help apply some skills I have right now to be an effective investor, to get into that?
Yeah, I mean, when you're doing your own single family homes, managing your property manager, there are a lot of carryover skills for sure. I mean, I was a civil engineer working on large construction projects. A little very different negotiating structure and dealing with little mom and pop property management companies and vendors than like what I used to do working for governments or big companies. But the thought process is there, right? At the very least, like project management skills, right? Those of us with good jobs, we're all right, right? We're employed, right? I was watching Criminal Minds, and they always categorize the killer as like, this guy holds down a job, he's halfway decent, right? You know, it's pretty responsible, right? And like, yeah, to own rental property, you gotta be halfway decent and organized, right? Like the basic skills, like, oh, there's a tree that fell on your rental property. Your property manager calls you up like the next day. It's like, hey man, this is what's gonna happen, right? Like this, I always had consultants working for me in my day job. I was an engineer. I can't design anything, right? I'm a project manager. I delegate everything out. I have design engineers designing my stuff. I have construction managers implementing plan. I have contractors that build the stuff, right? My stance was always like, yeah, Mr. Property Manager, tell me what I need to do. Right? What do you think I should do? Right? I'm not, most investors are like, blah, 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 blah. And I was like, look, no, you follow your experts, right? But then you're the boss, right? You have the overriding like vote. So hear what they have to say. It's like, hear what your employees have to say, hear what your consultants have to say, and you're making the final decision. So that's just basic project management skills, working with people.
Yeah, that's great.
And then keeping people accountable too, right? Like, all right, Mr. Property Manager, you're gonna call the tree for people, and then you're gonna get the roof repair people scheduled. All right, what is your timeline? I know your strategy. What is your timeline? Right? All right, I'm gonna put in my little notebook to follow up with you in 7 to 8 days, right? Just basic property management skills.
Yeah, and for those who may not have caught it, you're really talking about leveraging your team and leveraging systems there. Like I noticed you're not the one who's on site trying to take care of the problem, right? You're leveraging, as you said, experts to do that, or people on your team to do that, and you're keeping oversight. So that's really cool.
Right. Like, I mean, I got over 4,000 units now. I don't know how to do an eviction. Like, I don't know how to do that stuff. I read on like the websites like, oh, like my tenants are giving me a hard time with this like service animal. I'm like, what is this nonsense? Like, who cares? Your property, that's your outsource your property management for, right? Like, I don't know how to do eviction. I don't know like how to like properly screen tenants. That's their job, right?
That's the value they bring. And then even evicting, that go to an attorney, right? That's another expert you should trust. Why are you doing the actual eviction? That can get
I don't know,
kind of
man.
dicey too.
I mean, I used to say like a long time ago, I would like invest. I would go to like the local RIAs, which are typically not a good place for passive investors to go because you can just find the broke guys out there or the do-it-yourselfers. Like they would tell me like they do this all the time. And my old like landlord from college, he would like, poor guy would come and fix the toilet for us guys. And while his poor wife waited in the Mercedes out in the code. Like that's just not the way to do it. But I would say most investors do it that way.
That's interesting. So when somebody approaches you and they're kind of in this position where they don't know whether they should be a passive or active investor, how would you kind of, I know that you're more of a passive investor, but how would you kind of help them figure out which way they should go?
Yeah, so for investors that like book onboarding calls with me, I'm always trying to ascertain time and how much money do you have. The third resource is knowledge, but I'm assuming you don't have any, right? So time and knowledge, like if you're busy at your day job or you got kids, a lot of people like they find this stuff because something happened in their life. They had kids or something like that. They're busy. And then secondly is like how much money do you have? Like I said, to buy a rental property, you need at least 30 grand savings. If you don't have that, go and save, right? Or go find a way to make money. Wholesaling, flipping, tax liens, that's a great way to make money. Or go to your day job, right? Or figure out what's your highest and best use. Or maybe you're your own worst enemy at that point, right? You can't save money, right? You can't not spend money, right? But at least 30 grand, at least 30 grand. And then he needs a little bit of time. If you have maybe 5 to 10 hours a month to dedicate to this stuff, maybe you should go buy a turnkey rental or something like that. But certainly if your net worth is over $500,000, million bucks, I mean, I would say look into syndications as like the way to get in, to get on the highway the right way.
Yeah, absolutely. I like that advice, getting into syndications.
But I guess let me caveat that. Like I talk to a lot of like young bros, and they're like, "Oh yeah, I want to do syndication because multifamily, multiple roofs. I watched all these Facebook like ads. It's like, yeah, multifamily is way better than owning a 1 or 2 unit. You know, like yeah, no, duh, it is better. It's a hell of a lot better, right? Value add, blah 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 blah. But like, you don't got any money, dude. Like passive investing is better, right? When you're investing with the pros, it's better. When your general partners are putting their loans in their own name, you're getting bonus depreciation and they're doing all the work for you. You just sit back and do nothing. It's better. But you need money to invest, bro. Right? If you don't have a net worth of at least $250,000, $500,000, that's not for you. You got to buy your first single family home because that's what I did. I didn't graduate with any money out of college. I luckily didn't have student debt, luckily. But like I bought that first rental and I got to 11. It took me like damn near 6-7 years.
Yeah, and that's moving at a pretty good pace, honestly. Takes time, like you said. So Lane, tell us about infinite banking. This is a concept that most people do not know about, and I know that I know you know a little something about it. So I'd love to just kind of hear your thoughts on infinite banking and what you might say to somebody who, when they hear this, is a little bit more interested in it.
Yeah.
What they might consider.
Yeah. So if your net worth is under $250,000, just kind of take a nap at this point. This is for you when your net worth goes a little higher. But like basically you're using a whole life insurance product to store capital in and make a little bit of a return tax free. And that's the kicker, right? Because it's life insurance for some strange reason, it's tax free. So you're loading money into this life insurance policy and then you're pulling the money right back out as a loan from yourself and using that for down payments or whatnot on the investing side. So it's great for higher net worth folks to kind of float a little bit of liquidity through there. And another nice perk is that it's off the table of litigators. And yeah, you're making a little bit of a yield too. But the reason why I say it's not for like the lower net worth guys is like, I mean, every dollar you have should be going to putting into an asset, a property or whatnot. Because the little like twist of it is like there's heavy fees the first year on these policies, right? So there's a trade-off, right? A guy like $1 million, $2 million above net worth, yeah, definitely what they should be doing, right?
Awesome.
Well, as far as remote landlording, I know you talked about leverage the expert. So that is probably the biggest piece of advice, was one of the questions we had for you. But one thing that we want to dissect a bit more is if you have a W-2, what can somebody do to start today? And I know you're differentiating by different levels of net worth. So that's a very good thing you should look at. What is your net worth? But also, what would you say to those people that say, you know what, I have a W-2. I kind of want to be where Lane is. How do I get there?
Yeah, so I'd say like just generally, like if your net worth is under $250,000, $500,000, go out and buy a rental property, right? There's no better way of learning this. And quite frankly, I think of it as like a prerequisite to doing bigger stuff. Syndication deals are great, but like the problem there is like you're getting a pitch deck and there's really nothing in the pitch deck that tells you if it's a good deal. And for an inexperienced investor, you're just clueless, right?
Yeah.
It just looks shiny, like everyone can make a PDF these days. They just send it to some I don't know, Malaysia or the Philippines to get it done for $20 from some graphic artist, right? Like it's all the same. But it never tells you if it's a good deal or not, right? So that's what I say. Like if your net worth is under that, start with a turnkey rental, especially if you live in like a primary market. But like you need to kind of switch. I mean, don't be like me and buy 11 rental properties. That's ridiculous. Maybe get 1 or 2 and then kind of reevaluate, kind of go to the bigger stuff. A lot of like the accredited investors that go into syndication deals, it's the big game is just networking, but networking with the right people. Like I said, the online free forums and local BRIAs are the worst places to go because they're just filled with wholesalers, flippers, local investors that want to invest in their backyard. And I mean, who has time, who has a high paid job, working professional, more passive investor pedigree to go to some happy hour, right?
Right.
That's like none of my investors are super busy, right? They need to like, they got kids, they work till like 5, 6 p.m., right? And like their spouse is like, you got to get your ass home, right? Like you're not going to go drink beers with some bunch of 20-year-olds.
Very good point. Very good point.
So, Lane, you mentioned a couple of places that are not good, like the local RIAs. Can you think of any places that might be better choices?
I don't know, man. I mean, I made my podcast and I've been a little bit of a lightning rod to attract passive high net worth investors. That's how I've done it. But quite frankly, that's why it's hard, right? I mean,
Yeah.
nobody goes to the country club. Nobody plays golf these days. Nobody's got time for that stuff, right? I mean, maybe you can find high net worth people there, but I mean, I'm first generation wealth, right? People that are in country clubs and that kind of stuff are like second generation, third generation legacy wealth people. And quite frankly, they're more interested in talking about their Teslas and Lamborghinis than looking for cash flow prudent properties in boring parts of the country.
So it's about knowing who you're serving. I think that's also ultimately figuring that out is important to as well, right? Knowing who you're serving and then figure out where they're going to be. Exactly what you said. The types of people that you invest with aren't the people that are going there. So you wouldn't go there. You'd figure out where they normally hang out or find ways to attract them to you, and that will accelerate your growth. We wouldn't be the tech guys who invest if we didn't ask a tech question for you. So as far as what's happening in 2020, a lot of crazy things. So what would you say is your favorite piece of technology that's helping you get through the year?
I mean, just phone, right? Like I'm a big phone person, do a lot of video calls. I mean, I talk to all my investors, I build personal relationships with them. I mean, especially in a time where we're all separated, I think that's what people need. Um, and especially like relationships are the currency of the wealthy, right? It's very, very different with the wealthy value, I feel like. That said, to give you something tangible, because I listen to a lot of podcasts, it's always a lot of fluff a lot of times. Crisp is a app that I like downloaded a couple of weeks ago, and it's been a game changer. It like filters like right now, like there's like my air conditioner blowing super hard here in Hawaii because it's hot, and like if I wouldn't have this app, like you'd hear it like super bad. But like it's some artificial intelligence thing that like filters out background noise. And I think if my dog was barking right now, you'd probably hear it. But if I have the software running, it doesn't. So you can use this on your phone too. It's like $3 a month.
Wow.
Nice. Hey, that's good advice for the tech guys who invest, maybe.
I agree. I agree with that 100%.
Awesome. Well, Lane, thanks so much for your time. We've really enjoyed this. Thanks so much for adding value to our listeners. And many of them might like to reach out and find you, check out your show and your content. Can you tell us all about where people can find you?
Yeah, they can go to simplepassivecashflow.com. I got my podcast, Simple Passive Cashflow. If you are looking to, if you know, like I said, if you're under $250,000, $1 million net worth, I mean, I'd say turnkey rentals are probably for you. I mean, when I started the podcast back in 2016, that's what I was podcasting about. So the first dozen podcasts are pretty much foundational for that. Obviously, I've moved more towards syndications later on. But yeah, if people are accredited investors, totally willing to have a chat with you, just check out the podcast, build a relationship.
Awesome. Thanks so much, Lane.